Anyways, welcome guys. Thanks for coming in. So the issue that I'm going to discuss and talk about today are called tax issues affecting buyers and sellers. Part one, we deal with the foreign buyers tax, the non-resident withholding tax, which happens when there's a sale. And then there's assignments, both sales and purchases, so assignor, assignee assignments. And then and this is something that Calvin had asked me to address. So what happens if the buyer cannot complete? So I want to stick it into the context of tax. So what if there's too much tax and the buyer wasn't prepared and they need to back out? Then what happens? Of course, that situation applies to everybody. Like, it doesn't matter what reason it is for the buyer to back out. So I use that as a nice segue to get into that topic. So a little bit about myself, a little bit. I can't see who the participants are, but many of you may have dealt with me or at least asked me questions, and I've tried to do my best to help you with a question or two dealing with your sales and through text or WhatsApp. Anyways, this is myself. I've been practicing as a lawyer for 23 years. Actually, what day is today? Today is the 12th. In about, 9 days, so it'll be 24. My goodness, May 21st.
Oh,
kind of like
you
my
start when you're 10, right?
Yeah. Well, yeah. 10 3 times over maybe. Anyways, yeah. So real estate has been the primary area that I've been practicing, but not only purchase and sales and partnerships and dealing with the solicitor side, but also litigation when it comes to patent and latent defects and fighting against breaches of contract here and there, and also other parts of real estate litigation. So that I do that as well. Some of you may have situations where if a buyer backs out, couldn't, and then what happens with the commission? So we deal with that too. Anyway, so that's a little bit about myself. There's my cell number here in case you guys, if you do have questions and you're working on a deal and you need something, just a puzzling question, I don't mind quite often. If you text me your card, I know that you're a Jovi realtor, then I can give you some advice and so that you just get on to the next stage to finish your deal. It doesn't necessarily have to come to me, just so that I help your clients and the Jovi family all together. Okay. And again, thank you for having me. And the first part I want to go on is the foreign buyers additional property transfer tax. A lot of you may have clients that are buying from overseas, or they're in the process of immigrating, or they're already here, but they haven't got their status yet. So they might be facing this tax when it comes to their purchasing of real estate in certain areas of BC. So the first thing, next screen, who does it apply to, how does it apply, and where does it apply? So the first thing is, who does it apply to? Well, no, actually, we'll go with what is it first before anything. So 20% tax based on the value of the proportion of interest of a property being purchased by non-citizens or non-permanent residents of Canada. So you might have a person who's non-resident and someone who is. And then, of course, the percentage of the property being bought by the overseas, a non-resident person, the foreign person, that tax is payable on their portion, calculated on their portion. This is in addition to the property transfer tax, if it's applicable. So you have the regular tax, and then added on top a 20% tax on that percentage. So PTT, as you know, is taxable on the whole entirety of the property. So whatever it is, you pay it on it, and then you add this on top for the portion that the non-Canadian person is buying. And I'll just use the word non-Canadian to cover that. It makes it easier rather than defining who is and who is not Canadian, which we can do that later on. Okay. For who it applies to, foreign nationals, a non-Canadian. So people who are non-citizens of Canada and non-permanent residents. But there is an exemption if you client has applied for Canadian permanent residents through the PNP program of BC. And what the PNP program does is that they initially review the application and they give a nomination, which is someone that the BC government approves to apply to be a PR. And it's almost like the BC government has demonstrated to the federal government, which runs the immigration program, that they want to have this immigrant come to Canada and to be a part of BC's immigration program. So they apply and they get a nomination, which is a confirmation letter from the BC PNP program, confirming they have a date upon which the nomination expires, and that expiry date is for that person who's been nominated to actually apply for permanent residence from the federal through the federal program. Okay, so applicants who are Canadian permanent residency who have applied, but then if you don't have a nomination, then you don't have an exemption from the program, and you have to pay the foreign additional property tax. And of course, I mentioned a bit about the expiry date. So the person has to, the client or the buyer has to apply. But if they don't apply within the time frame on that nomination, then they're not exempt until they reapply for another nomination to extend the time frame and then buy within that time frame. Okay. So some clients of mine, they met this program, they had a nomination, they purchased the property, and they got the exemption, and then they want to apply again. They want to buy another property. Well, this is going to be a problem. Here, I'm going to go to the next screen. So if, oh yeah, here, this situation here, like maybe the person has applied, maybe didn't go to the PNP program, doesn't have a nomination, but they got something that confirmed that they are permanent residents. So the documents that you can use to approve, send it in to be exempt from the PNP foreign tax. You have a record of landing, we have a confirmation of PR or a PR card. So either of these documents, a PR card is a physical card, combination is an issuance. It's something you can be given a PR confirmation even though you're not in Canada physically. A record of landing is normally given when the person arrives in Canada and issued this document to confirm they're now permanent residents. They have now landed, physically touched down in Canada physically. Okay, so you have this as evidence. You can confirm it with as evidence of becoming a PR. Okay. Now I mentioned about before I go on with more exemptions, I talk a little bit more about companies. Okay, so you think that a company that's incorporated in Canada, okay, hey, it's incorporated in BC, it should be exempt, but that's not as far where it goes. You actually have to go beyond that and make sure, and this is kind of the new rules from the Transparency Act, and also the requirement to report who are the buyers of homes in BC, is that you have to actually look further. Hey, it's a BC company, no, not just because it's in Canada or BC, therefore it's automatically a Canadian company. Is not. You actually have to go further. And what they look for is whether there's 25% of the voting shares, the controlling shares of the company are held by someone not resident, a non-resident company, a non-resident person, from foreign residents. So they're looking after and trying to track down that even if a company is in Canada, hey, 1% is owned by someone overseas. Okay, well, maybe. Okay, that's the first step. They don't own more than 25% of the shares automatically. You have to pay, but it goes further. The definition of whether it's Canadian or not has to go further than that. Not just the simple ownership of how many shares, but it goes to whether or not they can control who the directors are. So they can be indirect controllers. They can be indirect shareholders and can control. Even though they don't have 25% of the shares. So for example, if a Canadian shareholder has 40, another shareholder has 30, another shareholder has 5. So that makes up 75, and then maybe 2 more, a couple more shareholders are in there. If any of these shareholders have the ability to say, I vote for this person to be the director. For example, you have someone with no one person has a majority, but they need that one last person to throw their vote in before they can vote who the directors are. Then by default, that person becomes a controlling shareholder indirectly. They could also be not by reason of owning shares and the combination of how many votes are getting by who, but also by agreements. This is meant to go after, for example, a silent shareholder agreement. Say someone who owns 10%, but they sign an agreement with the rest of the 90% shareholders that, hey, even though I have 10% on the record, on the books, my vote counts for 70%, so I get to choose. So they're looking for these. They're looking for these people or companies that may have control greater than what's registered. Okay, so that's the definition. So even though you may have it all recorded, it looks fine, looks dandy, 10% of the shares, that is not all. So just to be clear. just because it's incorporated doesn't mean so. But if they are incorporated in Canada, then you have to go further to see whether the tax applies or not. Okay. And then there's also the areas in which it applies. It's not everywhere in BC, but it's certainly many of the biggest areas in BC. So there's, when you go on site to the additional property transfer tax, they have a hyperlinks to each of these districts. You see that I've listed here, and you click on it, and it'll give you the list of all the towns and cities and areas in which it's included in each of these districts, and it's quite a lot. You know, Fraser Valley, you go from Abbotsford all the way to Mission and Maple Ridge, and then you go Metro Vancouver. It covers everything here. And Regional District of Central Okanagan, you have clients buying in Vernon, Kelowna, any of those outskirt places. Yeah, that's all covered, and you got to check it. And Nanaimo, Capital Regional District is Victoria, and of course Sydney as well, and all those areas there.
So, sorry. So cities such as, say, Burnaby, that follows to Metro Vancouver?
Yeah, exactly. So, you know, you click on the link here. I don't have the hyperlink, but if I email you the my PowerPoint and make it into PDF, I can put hyperlinks right in, and you can click on it. It'll go right to the city, and you can see it. But you can also just go the Foreign Additional Property Transfer Tax website, and they have this listed. You click on it, and boom, it goes right through all the areas and cities and towns, and that they're all part of this, and whether it's in or not. So, or you think that, hey, it seems like it's outside of Metro Vancouver. It seems like it's outside of Fraser Valley. But you don't just rely on that. Go and actually check and make sure. Okay. As actually, when I was going through these, it's a lot of places. I think that if you go through this, then unless you're buying in Nelson or something, there's no pretty far up. You know, Port Alberni further up north, and then Vancouver Island, small places which, I don't know, you know, it covers a lot, so just be careful. So I mentioned, let me go back a little bit further. Right, what is it? Yeah, you know what? I don't have the section here, but I want to add a little bit section about this. I had a client who had purchased a home and got the exemption as a Hong Kong resident, national, not citizen, applied for but not yet received a nomination. And so then it was purchasing another property, and thinking that in the mindset, what is the program of the foreign property tax, additional tax aimed at? Is it aimed at non-Canadian? Okay, fine. Then you just, if you're a resident, it should not matter. It really should not matter how many properties you buy, as long as you are a permanent resident. You've got the nomination, you're coming in. You should be exempt from having this tax no matter how many properties you buy. But then if you have to read, of course, you have to read it, the fine print, and you say, oh my goodness, it's more than that. The PTD office has this little one-liner, basically says, if you got this exemption once, you can't get the exemption again. You're only allowed one exemption per person who's overseas. So it's not like you're Canadian, you're a permanent resident. You can buy as many as you want, you just pay the tax. You don't have to pay the foreigner tax. That is not true. You actually have to, as a buyer who is a non-resident, they actually have to choose one of the properties that they buy to be their so-called resident, that the home that they will be living in when they buy, and that they expect and plan for that place intended to be their principal residence. But if you can't have two principal residences, so you can't have exemptions. And if you got one exemption, you can't do it again. You got to pick and choose. That's the first thing. So if you've already done once, and it's not just because you've got your PR, you've even gone landed, but but you've got this confirmation of PR that sometime before you got that, you bought this home and you try to get an exemption, you can't even get a refund, because during the time that you bought it, after you became a permanent resident, you still had to have chosen one of them to be your principal residence. You can't have two. Just like you can't claim a homeowner's grant on a real estate that you own twice in 1 year. You have to choose one or the other. Anyway, so I mean, before this came out, I thought it was just aimed just at Canadian, non-Canadian, but no. And then there's a further thing, has to be principal residence as well. So be careful. It's not that obvious, and you think that it's not targeted for residents or not residents. So So just two things. Are you a resident, Canadian? Is this your home that you will be living in primarily or not? And then two questions to ask. Okay. I want to go to the next question.
Sorry to interrupt, Ivan.
Yeah, no worries.
So everyone, I'm taking the attendance here for the PDP credit. I see some of you have just a first name. So, because we had a few agents that has the same first name. If you can change your name on your Zoom to your full first name and last name, that would be great. You can do that. If not, if you don't know how to change it, you can at least type your name in the chat here, so I can take attendance from now on. Okay. Thanks, Ivan.
Yeah, no worries. Yeah. Yeah, I think if you get PDPs, even better. This is great.
Yeah.
Yeah, I wasn't sure whether or not we can do these for PDPs, but it's great. And then
yes, you can do that.
Yeah, so the topics are all relevant, and you can do these things for your agents, which is great. So awesome. Anyway, so we're gonna go to the next one. No, of course, the foreign buyers tax all deals with purchases. But say if you have a client who is a non-resident who's selling their property. So then you have to face with another kind of a tax called a withholding tax, a non-resident withholding tax. And you come across this and you have to deal with it, unfortunately, because there are certain CRA, Canada Revenue Agencies, I don't know, how would you say, collection tools, how would you say? CRA has made every citizen of Canada their tax collectors, unfortunately. And you think, hey, if I'm a tax collector for the CRA, why am I not paid? Unfortunately, if you don't pay as on behalf of the CRA and collect taxes that are due, you have to be responsible for that tax, which is a pretty significant burden. But that's the CRA for you. Here we go. So you, on behalf of all the buyers who are buying from a non-resident, you better make sure that any taxes that are outstanding or to be due or supposed to be paid or not paid is actually paid, or arrangements have been made to pay it, or else the buyer can be liable for it if they didn't do that. Okay, so what is this tax? And how is it processed? Okay, so it's a tax that is applied on the income of any non-residents of Canada, including citizens of Canada who are not Canadian tax residents, and how much they make in Canada. Now, income is defined broadly. When it comes to real estate, as well as most likely the gain. Like if they buy a property for $10 and you sell it for 20, well, the gain. But the gain, the $10 is 25% of that gain, which is called income. Now, whether they call it, it's an investment, it's more like an appreciation, it's not income. Doesn't matter. The CRA will look at that as income. If you're a non-resident, you're never meant to live in it, so it's going to be income. So 25% of this income is taxable. So $100,000, $25,000 tax. $200,000, $50,000 tax. Nice and simple. If that is the income you make. But of course, I'm just mentioning this because it can come from other sources. Sale of real estate is just one of them. Okay, it could be shares, it could be whatever. Any property you own in Canada. Okay, how is it processed? Well, if there's something that's being sold and being made, income being made, selling or transferring in BC for purposes of real estate, 25% of the price of the fair market value of that interest has to be held back by the buyer. So the buyer is responsible if they don't hold it back. If you didn't hold it back, should have held it back, forgot to hold it back, and then the seller takes their money and they leave and there's nothing held back, okay, buyer, you're in trouble now. You're going to have to pay for it. So that's how the CRA looks at it. Normally, the buyer's representative is the one that does it because they're protecting the buyer naturally. They're not, protecting the buyer against any liability. The buyer's representative in a real estate transaction holds it back, waits for proof that it's been paid, and then allows for that holdback to be released. So that's the second part there. 25% of the value is held until something called a clearance certificate, which is issued from the CRA, confirms that the amount payable before that transaction has been paid. Okay, so that's how the transactions work between lawyers and undertakings. So pretend I was the buyer's lawyer. We're dealing with the sale on the closing day. I have arranged with the seller that I will hold back 25% of the purchase price, and that'll be in statement of adjustments between me and the seller that I prepare, that I'll hold back those 25% funds in my trust account. I wait for the seller to provide me with that proof that the withholding tax has been paid or is not payable, or it's been filed and nothing is due. I get the clearance certificate from the seller, and then I release the rest of the money back to the seller's representative. Now, sometimes what happens is the seller says, hey, I'll undertake to hold it back instead of the buyer. Well, that's okay, as long as there's protections and safeguards. You have to write the undertaking, which is the conditions upon which the seller holds that fund. So I would say to the seller, you are not to release the rest of that 25% holdback to your client, the non-resident seller, until I have received the clearance certificate and I have authorized the release. So there's two further things. It's not just, send it off when you got it, you didn't tell me. And if I represent the seller, then I would do the reverse, like, Mr. Seller, allow me to hold it back. I'll release it to my client once I give you the clearance certificate. And in between that time, normally I have a number of real estate, accountants that I work with. If the non-resident person doesn't have an accountant, then I make arrangements for them to retain one. And the non-resident client would get a retainer agreement with the accountant. The accountant processes the application for the clearance certificate for this transaction. I get the resident, the certificate of clearance from CRA, but before that, the accountant normally tells me, hey, Ivan, I got the notices from the CRA. $15,000 has to be paid in order for the clearance certificate to be released. And then therefore, then the money gets paid. Usually the client will give me the money, I pay for it, then the rest of the pullback can be given to the non-resident seller. Now, sometimes I'm authorized by the buyer to pay the non-resident withholding tax from the holdback. So if I'm the seller, I'm given the money to hold back, and I'm holding for the seller. The buyer, I can ask the buyer, hey, permission that, hey, can I get the money in the holdback to pay for that tax, whatever is due, and then once that's been paid, then of course get the clearance certificate. So that also happens as well, but that has to be arranged. That has to be discussed with the seller and between the seller and buyer. And it's not always that obvious. I've seen contracts which isn't really clear who's supposed to hold, who's supposed to take care of it, who's supposed to wait for what, who's supposed to pay for what. Maybe if you're drafting a contract that is a non-resident seller, or maybe it's unclear whether the resident or not. So just be sure that those wordings in place in the contract to take care of that. The buyer is to hold back 25% of the purchase price of the assignment, well, if it's an assignment, with the assignment amount plus the flip, or the amount with deposit plus the assignment amount. Hold back 25% of that in the buyer's trust until a clearance certificate has been issued. So it's obvious as to who's holding back, and so it's clear. Okay, so that's a bit about the process. Now, I just mentioned a little bit here about timing in here. So accountant usually applies for this. I don't do it for clients. The tax rules are, it's a whole nother ballgame. So I don't get involved in applying for it and filling in the forms. I get accountants to do it. I've seen fees, they range from 1,000 to 3,000, even less sometimes, but you have to be, for accountants, and I clarified this the other day, not only do they file for a clearance certificate, which is confirmation of how much is owed based on the sale, and then process the payment and get a clearance certificate. But there's a second part to it, like there's a withholding tax return. Some accountants will do it, some won't. Some will file it as part of their fees, and some say it's a separate fee. So just be careful when you go out there and your client wants to look and you have an accountant to recommend. Make sure that they know what the accountant is doing and what they're paying for. There's two parts, okay? There's the clearance certificate part, then the filing of the withholding tax filing return part. The reason why there's one or two is sometimes when you based on just the property being sold, and if there's a profit or not, you pay the tax, but sometimes there's other costs involved. Maybe there's an appraisal cost, an expansion cost, repair cost during the time frame in which you had a property, the seller had a property, and you reduce this from the total amount of taxes payable, and then you file a tax return in order to be exempt. There's certain exemptions and reductions of potential costs that you can do with a further filing. Okay. Some accountants tell me that it's once you file it, then the CRA actually gets more involved and may do an audit on everything. And some are saying, hey, better to do it right and correct and have be obvious and showing it to CRA that you're going to do it properly, and open yourselves up to audit as a better way of proceeding. So I don't know if it's a one-off and sellers is selling and they're no longer coming back anymore and they don't have any other assets. Maybe, I don't know. Anyways, I can't give advice on that accounting end. So get an accountant, find out from your client, make sure that the accountant tells you a good thing, buy it, file it. What's included in the price, what they're going to do, and why they're going to do the filing, and if not, why not. Okay. So I've heard
there's questions in the group about the accounting. So how much usually the accountant charge to get the clearance certificate?
So I've seen fees from 7,000. No, sorry, not 700.
There will be a lot of fees.
Yeah, 700. Yeah, no, not 1,000. So sorry though. But anywhere from, like I mentioned in my screenshot, 7,000 from to 3,000 to process. They include it, sometimes don't include. I've seen it so that it could be 700, 500 for just the clearance certificate, and then the balance like 500 is usually. It seems like it's less money if you just do the filing rather than applying for the clearance certificate. Okay. Well, of course, for purposes of real estate transaction, you don't need a filing in order to release the holdback. You just need the clearance certificate. So you want to do the bare minimum, just apply for the certificate, get the certificate, release the holdback to the seller. Okay. And further down about, I've been asking questions from real accountants as to what documents I need. So quite often they need the property transfer for the contract. If it's a transfer, the transfer agreement, otherwise the statement of adjustments and the purchase of sales contract for the accountant to make an application. Question sometimes comes when family members are transferring to family members, like mom and dad. They bought a place with their student visitor who's here in Canada, but the parents are overseas, and say, hey, I bought your house to live in the meantime. Oh, geez, we're going to have a speculation tax. Oh, shoot, okay, better transfer to you. Then your family transfer happens, but you can't just say, hey, I give it to you for rock bottom price or something like that. Nothing. You still have to get a value and still need to show proof of value, not how much was transfer actually paid between the transferee and transferor, but an actual appraisal, or and I've been asking some accountants, well, why can't they just use the BC government BC assessment? Using the BC assessment opens it up to an audit. That if you use an appraisal, they're not going to quibble with a formal appraisal from a recognized appraisal company. Okay, so those are the two things. So why and why not? Okay, everybody hear me? I hear I see a connecting to audio. Everything's okay? Everybody heard me? We're good? John, can you hear me? Maybe on the chat, if people can tell me if you can hear me, because I saw a little emergency thing, a screen showing up as the connection to audio had a problem. Everybody can hear me? I'm gonna go on to chat to see if you can hear me. Chat. Good, excellent. Okay, we'll continue on then. Thank you. So anyways, next slide. So I just mentioned this earlier. So when the amount that is owing, that's calculated by CRA, is paid, then a clearance certificate is issued, and then I can give the rest of the monies back. And there's a question I mentioned earlier, just to refer to it in passing. The tax may apply in the event of an assignment of a presale where the assignor is a non-resident. And what they use to calculate it is not just the deposit that's given, but the assignment amount on top. So the total assignment price, which is a deposit plus anything extra that the Canadian resident buyer is adding on top in order to get the assignment, to purchase the assignment. So it's a whole amount that the CRA will ask for, in which the buyer is required to pull back, okay? And not just the extra profit amount, it's the whole entire price. Just like if you have a whole price that's 200,000, you hold back 25% of the value of the whole entire price, which is 50,000. Same thing for an assignment. Even though you can say, hey, you know, the assignment amount is the deposit plus the flip, but the deposit is only 10. Why can't you just hold 25% of the flip? That's not CRA. Don't try to argue with CRA and try to do that either. So I've had contracts that I've seen which divides it up. You know, the so and so will pay the amount on the deposit. Well, what about the amount on the flip, or vice versa, the flip and not the deposit amount? So you got to think about the whole entire thing. Okay. Next one. Okay, that's enough for the withholding tax. I'm going to go to the third tax, which is GST. So we have pre-sale assignments, brand new properties. GST is usually applicable only when it's like a substantially renovated home. So you have an old house, but it's practically been demolished, and a new occupancy permit has to be issued from the city. That becomes now a GST applicable product. Of course, developments, condos, pre-sales, those are all applicable as well. Okay, 5% on top. If the price includes GST, then it's great. And when we as lawyers for the buyer or seller, we have to back out the GST from the purchase price if the contract says GST is included. Property transfer tax is applicable or payable on the net amount, net of the GST, so we do that. Be careful. Here, I have on my second bullet point here. Pre-sale price includes GST. And then there's sometimes what you are, bullet point 3 is sometimes you get allowances from developers as credits. Now, the buyer usually doesn't have a choice as to say whether or not they deduct it off the purchase price or not, or does it just become adjusted as an item, a line item on the statement of adjustments. So if you're representing a buyer and you want to try to get the best and ultimate benefit, have it so that it's deducted from the purchase price, because if you do, then guess what? The GST goes down, the property transfer with the tax goes down. And if you happen to be a non-resident buyer where you don't get exemptions, well, then that tax goes down as well. So it's all benefit, but you normally can't decide that on the completion date. Normally for these pre-sales, me acting for the buyers, that we had a package from the developer which tells me exactly how those credits, allowances, declaration allowances, etc., to be put on the statement of adjustments. I don't have a choice. 99% of the time, it's not the deduction from the purchase price, but once in a while, they do happen, and it's nice when that happens because everybody gets the benefit. Like less GST, well, except for the federal government and the BC government, they get less PTT, they get less additional tax, they get less GST anyway, but it's good for the buyer. Okay. So anyway, so the next bullet point, be watch out for when it comes to pre-sale assigned to an assignment, that assignment amount, there's GST on top. So most of these assignment contracts have a section that deals with the GST, has to be dealt with somehow. If it's silent, normally, people all under the wrong assumption if it's not applicable or not. It's better to be clear. Normally it's the buyer that has to pay, right? And the seller has to collect normally and then remit it to the GST office, right? So, but then here on the second bullet point here, something to watch out for is a buyer of an assignment. So the assignee. They buy the assignment, they pay GST on the assignment amount. So on the deposit that they paid back to the seller or the assignor, and on top the flip amount, GST on the total amount. And then when they complete later on, when the whole project is ready to complete, they pay GST again on top of the whole entire purchase price. So yes, they do pay GST twice, because there's 2 times in which it's applicable, at the time of the selling of the assignment and the time of the selling of the actual project itself, when it's actually finished being built. Yes, there's 2 times. Now, just a little note, just in case, sometimes buyers are expecting an exemption from paying the GST, and say, hey, look, I have a purchase price, but first-time buyer, it's going to be 500,000, and therefore I can be exempt from the GST because I'm a first-time buyer. I'm going to use that exemption and get the GST rebate, etc., from $450,000 price. And then, you're a home buyer and thinking of saving on the PTT. Your client may be thinking, oh, I'm going to take advantage of the $750,000 exemption value total amount for first-time buyer of a pre-sale. And then all of a sudden, the credit that's supposed to be a decoration allowance deducted, but added on to the price maybe, or if you buy a extra parking lot, for example. And all these things are added to the purchase price or put it as a separate line item. It may disentitle your buyer to any of these exemptions. The example I get here is a PTT, where the limit of a brand new purchase of a brand new build, $750,000 value. So maybe it starts at $70,000, and then all of a sudden they had bought an assignment who had to pay on top. So PTT office look at adding on top of the purchase price amount, the amount that the assignment, the flip amount added on top to calculate what the value of the home is. Say you had a $50,000 deposit on the assignor, and you have a $50,000 flip price, so the total price you pay is $100,000. You add the GST on top, you pay it, you got the assignment, you're ready to complete on the actual contract. And then your purchase price now by the PTT office, in their mind, is that it's $750,000. So you've hit the next level up, and therefore you be careful. You might have to pay. All of a sudden now you're no longer exempt and add PTT onto the budget. Be careful of this, and similarly with the GST. I'll talk about this later on, but there is the rebates you can get from the GST. Okay, here, hold on a sec. Next one. Yeah, there are GST rebates of up to 36% of the GST owing. So you calculate the 5%, but 36% of that 5% can be exempt so long as the property or the price does not exceed $450. So again, you better watch out if you bought an extra parking stall, you bought an extra storage locker, and the developer decides to add that price to the purchase price, and then the price goes up, PTT goes up. All of a sudden you may be exempt, not allowed to get this rebate anymore because the price went to $455, or et cetera, et cetera. So just be careful of these things when you're dealing with all these things. You just don't know when you advise your buyer client, when you're doing calculations for them when they're getting. Of course, their mortgage advisors may have that information as well, but it's good just to you're representing the buyer, so you calculate that and you advise your client accordingly. Okay. Next screen. This deals with the exemptions. Right? Now, before we go there, I want to say one thing. The developer has the choice of whether to allow the buyer to rebate upfront when they buy or not. You can't just tell the seller, hey, I'm eligible for the rebate. Don't charge me. I don't have to pay. But that's not always often the case. Quite often the developers, especially in the last couple of years, they make the buyer pay. And if you want to apply for the rebate, you apply for it after you pay it all. So you actually have to submit everything to the GST office in PEI and provide proof of payment of what you paid, and then apply for the exemption. Sometimes it's a proof that you're actually living in the home. And then you have to provide proof of that as well, so that you get your exemption, or proof that you're renting. So there's a rental rebate as well, right? But the rental rebate has to be on a term that's greater than like a year, a long-term rental. If you bought this home, you pay the full GST, you found a long 1-year term rental agreement, you provide proof of that, and you apply for the GST rental rebate. Okay, if it's not buying, it's to live in, you're buying to rent for your client, then at least they know there's two things. But at the same time, make sure your buyer is prepared to pay the full amount of the GST on completion, and don't expect the developer to do a credit to the buyer on the day of completion. Okay, so that's something to add on when you're advising your clients. So I talked a little bit about this, about the GST. Now, one thing I want to talk about is the last part, was my third bullet point. Say you have a client, or second and third, your client wants to buy a property that's just brand new, just got completed, and the seller who bought it now wants to in turn sell it to the new buyer. If the seller hasn't lived in it, hasn't rented it out, and in less than a year, GST will look at this as a GST applicable transaction. Even if you say, well, it's not from a developer, well, CRA looks at the new seller as if they were a developer. They deem them to be a builder developer for the purposes of GST and collection. So the buyer comes in, didn't write down in the contract that who's supposed to pay. GST was supposed to be paid, but wasn't paid, then there's problems. Okay, if it's applicable, but it's not, and then there's problems and issues that comes up, and this happens quite a lot. There's disputes before completion when the seller's lawyer says to the buyer, hey, your buyer's supposed to pay the GST, it's applicable, and the buyer goes, well, what do you mean? You never said anything about it. So don't assume that. The best way to best practice acting on behalf of a buyer, because ultimately it's the buyer that has to pay the GST, is to say if the price includes GST. And it's better to not only say the buyer includes, and quite often I see the contract that says, if applicable, then the GST is included. But if GST is included and the seller disagrees, then you have no, there's a problem. So whatever it is on the contracts, make sure that the GST is that the price includes GST without saying if applicable. Even if the seller disputes it, argues against it. Well, if it's included, then you pay, and if it's not applicable, then you don't. But don't put if applicable, because then there's disputes. Hey, it's not applicable. I'm not doing anything about it. Well, no. If it put it down in one way or the other, the seller has to deal with it, because the buyer has to only pay what the purchase price says, nothing else. Nothing else. It's more certain. I have disputes about this all the time. I have to deal with it. So, anyways, CRA's position on assignments, like I just mentioned, any profit is considered in most business income and taxable at 100% rather than capital gains, which is 50%. Whether it is taxable or not as income or as a capital gain, you have to think about this is whether or not the purpose of the buyer when they bought it and what the purposes are when they're selling it. And how do you prove intention is very, very tough, but the CRA looks at circumstances. If you intended to live in this property, then you must show that you actually either bought it and lived in it or tried to live in it. And if you never did, then you never meant to have lived in it. So the person who bought the pre-sale doesn't live in it, doesn't rent it out, sells it, you can't really prove that you actually want to live in it. And how do you prove intention, right? That's very, very difficult. I give you an example of a case that I helped with. A client that claimed that this was their principal residence and therefore they shouldn't have to pay any taxes on a principal residence, whether it's capital gains tax or withholding tax or PTT and the exemption from the property transfer tax. Is that the PTT office got 1 year's worth of PC Hydro statements from PC Hydro, and they give a notice to my client, say, hey, look, it's the same amount from January to December. We don't think you lived in it. Therefore, you're not principal residence exemption. Whether it's for the GST new home buyers living in exemption, we think that you are not living in it and you're trying to exempt yourself from paying this tax, and therefore there's a reverse onus that the homeowner has to prove that they actually are living in it, or else we can be dinged for the tax. Okay, so CRA is kind of like that. They don't look at just what you say, but they look at what you've done, what you're doing, and proof of what you thought of was in terms of your intention at the time of buying or selling. Okay, so be careful on that. So some of the things they look at, the type of property, pre-sale, Christ, you can't, you've had 3 or 4 properties, then how's this one to be your principal residence, how long you've owned it for, short period of time, sell it, flip it, then they look at the intention is to flip it. Your history of selling similar properties, if you've done this and done this and done this again and again and again, then they're unlikely to, again, believe you that this is your purpose. whether you worked on the property, like, you make some things such as installing things to make it applicable to your particular preferences, like, I don't know, say it's a property that you needed an extension for. If you put some work on it to build it for your in-law, and then all of a sudden your in-law dies, and boom, then you prove that you actually intended to have your parents live in it, but they're not alive anymore, therefore you need to sell it. Things like that, okay, and why you sold the property. So they look at all these things to determine what is your intention. I mentioned this a little bit ago. If there is no tenant, new buyer has never lived in it, the CRA will look at the seller as if they are actually a builder. Knowing that's what CRA position is, and that's how their attitude is, and that's what they're looking for, then allows you to deal with them on behalf of buyers when it comes to sellers who are stubborn, saying, hey, don't worry, no GST. Don't worry, no GST. I'm not going to sign any GST. I'm not going to say it's included, not included, blah, 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 etc., etc. If you know that, and you might need to do some digging around, protect your client from any GST by saying, hey, it includes GST. And if you're worried about it, Mr. Seller, then what's there to worry about? It includes it. Whether or not you have to pay, you have to deduct it or not. You don't, as a buyer, representing a buyer, you don't have to worry about it. Whatever you're supposed to pay, it's already been paid. You don't have to pay anything else on top. Okay. Now, the other thing, the last part of part 4 is, hey, because I had the situation 4 years ago when the foreign buyer's tax first came out, and a client was a student. Parents helped with the purchase of the property for her, and then this was like September 2016, I believe, or 2017. Anyways, the promise announced this new tax, and it's not grandfathered. And my client had to pay an extra 80 grand, and she said, where am I going to get that from? What if I back out, and what if I just lose my deposit and back out and move on? But anyway, so this is an issue that's come up, and I use this as a segue into this next topic. So too much tax. PTT, you become not eligible. All of a sudden, you have to pay the 5% on top because you're betting on 450. Now with the extra purchase of the extra storage and extra parking stall, you're not exempt for the GST rebate. Boom, and then because who knows, for whatever reason, you bumped over on top of the not only that, but also the PTT amount. So you have to pay property transfer tax even though it's a new build. Now you have to pay 1% plus 2% extra on top of the first 200,000. Boom, I can't pay. What do I do? Okay, so next one. So that, just I mentioned about that, the foreign buyer's tax, it wasn't no grandfathering. You had a contract that existed prior to it. It still applied regardless. Some people argued frustration of contracts. Some people argued that, not something they could control. It's like a violation of new zoning bylaws and new pet restrictions that you weren't aware of. But anyways, class action suit. I don't know if you've heard about it, but I have a whole number of my clients who are overseas. Couple of German clients and some from Hong Kong, all part of this class action suit to fight. The BC government fought it pretty good. The first shot, they canceled it. There's an appeal going on, and right now they're waiting for an appeal on the class action. So anyways, if the appeal is successful, then we're gonna game on again. But right now it's all on hold. All those people who have been paying this for the last 5 years. We'll have to wait a little longer to see whether there's going to be any compensation. Okay. Anyways, backing out. What happens if the buyer says, I can't buy? Okay, some question. These are situations that I've gone through and represented on behalf of buyers and also on behalf of sellers, negotiating with the buyer. So first thing we can do is we can come to an agreement. I put a little B there, but it's meant to be an A. So seller agrees with, to ask for an extension to time, but may ask for money to compensate for that extra time. So in the meantime, hold on, let me see. May ask for more money, release the sum to seller, keeping the adjustment date. Yeah, so they maybe just say, hey, we extend some time, but pay us for some of the costs of extending the time while the buyer continues to go look for extra monies and sources of funds to buy. So, they may have a mortgage on title, so they have to pay the per diem. Well, because, hey, it's not their fault. We don't want an extension. It's not our fault that the buyer can't come up with funds to complete. So they might ask for legal fees, home insurance costs, mortgage strata fees, things that keep everything that the seller at least is not out of pocket until the time in which they close again. Okay, and then adjust that on the statement of adjustments. Second one, the seller was waiting for an excuse because they have a better offer waiting around, and they're like, the first crack at opportunity, they say, you can't buy it. Oh, great. Okay, let's cancel and move on and return the deposit back to the buyer, which is in an ideal world. It'd be nice if that happens and the buyer gets everything back and they don't have to worry. But that doesn't always happen. You can't always wish for that to happen. Another thing is the seller accepts the breach, calls it a termination of contract, and then sues the buyer for compensation, including getting the deposit as damages, and they call liquidated damages. Sometimes you see that on some contracts. Sometimes you know, what does liquidated mean? It actually means that is a genuine pre-estimate of damages as if it was suffered. Because normally you have to prove damage, prove loss, prove that you lost and spent some money that you can't recover. When you put in the words liquidated damages, it just sort of means that the person claiming it or asking for it doesn't have to prove that they actually lost that, and then just agree to be that is how much that they lost. So you might see that in some situations that deposit is liquidated damages and given back to the seller. Not given back to this, but given to the seller or forfeited to the seller. And then in the event that the seller is not able to sell the same home at the same price, but has to sell for lower, they can add more and claim more from the buyer. They can sue them for the difference in the price and add their fees for dealing with that part and other costs of the seller. The other costs being the other items that here, first scenario, if it wasn't for that, then I wouldn't have to pay more mortgage fees. I wouldn't have to keep on the insurance and et cetera, et cetera, et cetera, that they added on top of what it is that they're suing the buyer for. Okay. So this is a case that I just wanted to, this is my second to the last screen. Case law alert. Now, this is a pretty old case, but it's a BC Court of Appeals. It's a pretty strong precedent. So if and ever you decided to go through the BC, the free law website that you can check for cases in real estate cases called Canley. Actually, I think it's canley.org, but anyways, canley.ca. You search for BC cases and look for certain things. This is the Court of Appeal. So whatever cases you look for, if you decide to want to find out yourself, Court of Appeal is stronger authority than BC Supreme Court and also stronger than Provincial Court and even stronger than anything dealing with the Residential Tenancy Board decisions, okay? You want to look for cases that are BC Court of Appeals to be authoritative. And in this case, it was 2013 case, they said that this ruling, and this ruling still applies in general as a general law for BC, and deposit is forfeited if the buyer backs out, and the buyer's fault, not the seller's fault. But if it'll be used towards as a deposit towards the purchase price if the buyer completes. Deposit is therefore more than just payment on behalf of as part of the purchase price. The deposit is security for the buyer's future compliance with the rest of the contract. The purpose of the deposit is to make sure that the seller doesn't have to worry that it's just meant to hold the deal up so that they can just take off and not buy later on. There's no real need, therefore, to prove that a loss has actually occurred to claim the deposit. So that's a general rule. Now, there's other things and other legal factors when it comes to push and shove, but this is the principle. Which other things would, other factors may affect it. One of the biggest part of this claim is that there's nothing that the seller has done wrong. And of course, there's a certain law in BC called the Law and Equity Act, which says that anyone who's seeking relief from the courts should not have done anything wrong themselves. So if you fooled somebody into backing out or breaching their contract, or you said something wrong to make them do it, then you may not be eligible for the relief that you're looking for. Okay, So they call that the clean hands doctrine under the law of equity. So if you want help, your hands better be clean too. So Mr. Seller. So anyway, so just put that as a word of caution, because some things, normally some people think it's a straightforward slam dunk when it comes to, as a behalf of a seller, getting the deposit back, and not necessarily so. But on behalf of the buyer, you got to look at it this way too, is that it's by default, it's there not just because it's helping you buy later on. It's proof that you want to buy, you're interested in buying, and it's security that you will comply with the rest of the terms of the contract later on. Okay, so anyways, I think that is, hold on. Oh yeah, one more note. This is my last point. This is not dealing with condos and pre-sales normally, because normally the deposit isn't that high. You know, you have 5% here, 5% over there, 15% down later on. But normally anywhere deposit from 10 to 20 is generally safe in terms of being called as a deposit. The problem is that if a deposit is so high relative to the actual price, the forfeiture of that may seem to be more like a penalty. It's not a hard or fast rule. There's cases which goes both ways, but generally there's cases which say, hey, 10 to 20% of the purchase price as a deposit to be forfeited if the buyer backs out. It's reasonable to call it as a deposit. But if you get like, you know, a $200,000 home where it's a $100,000 deposit, it's forfeited if the buyer backs out. You're bordering, you know, to have this deposit, even if you have language in the agreement saying that the deposit is forfeited, liquidated damages, et cetera, the buyer can still challenge it by saying, hey, you know, I know I agreed upon it, but I think that's a penalty. You can still challenge it. So, you know, not that straightforward. I just want to put that out there because if that situation arises, it's not that straightforward. You might have to look at further details of the case to make that assessment. Okay. Okay. That is it for my presentation today. So we touched on a whole bunch of issues, all related to taxes. So we are now, I think, open for. Oh no! I think we're gonna let's do a draw. Okay, is that okay, John? Are you still on?
Hey, Ivan, we have questions from different agents.
Oh, hey.
Let's answer the questions first, and then
Yeah.
we'll go to the draw.
Not a problem. Yeah, you go ahead. You can choose. If you choose a question, then you can read it out, and then I can see what I can do to answer that for you guys.
Yeah. I'm just gonna read the questions. It's just easier.
Or you can ask the whoever wants to ask it to unmute them, and you can ask. It's okay. Either way.
Yeah. Okay, so can they just give to their child? I thought you're allowed to give share to spouse, immediate family.
In relation to the question probably is not complete. Is this in relation to the GST, the foreign buyers tax, or the additional tax, or the the withholding tax? I'm not.
The tax part.
So maybe we go to a foreigner, non-resident Canadian who has a property and that they're transferring to their kid. Okay. Now, the CRA's office will look at this and say, well, look, you're a non-resident, you're disposing of assets, and you may or may not have made some money or profit from it. And now the profit is defined generally. It's not like, oh, I'm giving it for free to the kid, therefore I shouldn't have anything. No, it's not what they look at. They look at, has the value of the property increased, and what your value that you're giving to the kid is worth more than when you bought it, regardless of whether you give it to free or not. The CRA isn't looking for that. And CRA is looking for income or profit based on market values. And so then we still have to do, and as a family member, oh, I'm getting this profit, this interest. Now the only thing that if, for example, no withholding tax, well, let's switch to withholding tax or any kind of federal tax. If there's no inquiries made on behalf of the buyer or the transferee, like the person who is a family member, and they can be dinged for that tax and deemed to have owing that tax if they didn't report that tax. And then you have to fight as a transferee, as a family member. You can be dinged for what your maybe at the end of the day is zero, because there wasn't no profit, there wasn't no income, and there wasn't no withholding tax. But you have to deal with the CRA breathing down your neck, asking for that, and maybe suing you for that, because you didn't prove that you didn't owe anything. Okay. At the end of the day, if it's zero, there may be no tax because no profit was made and no income was made. But you don't either, as a buyer or seller, you don't know that until the CRA has made a determination of that. So it's not like they're saying you can't sell or buy. It's that you as a seller, I mean, a receiver or an assignee or transferee, you have responsibilities on behalf of the CRA, regardless if you get it for free or not. Okay, does that make sense? That comes with that's the federal government tax office, but the same thing applies for the provincial tax office. Okay, if the person is transferring and of course the buyer is Canadian, okay, that's fine. You don't have to worry about a foreign property owner's tax because the buyer is Canadian. But then to look for, if you're trying to claim an exemption, there are exemptions. For example, the family member exemption for a principal residence. If the kids are Canadian, they're BC, they lived in the home for more than a year, and then the non-owner foreign resident family member transfers it to their kid, they have to fill in this PTT form that says that we're trying to claim a principal residence / family member exemption. And then CRA looks at, not CRA, PTT office will look at this transaction and they can audit it. Well, prove to me that you lived in this home for more than a year. And quite often, if the family member who got the property, they don't have enough evidence, all the bank records, claiming the homeowner's grant from the city, filing their tax returns showing this is their principal residence, and because I've had clients that their kid was a student, and they sometimes live with their aunt, and then they got this house and they never bothered changing it because their aunt is always there, and they get all their mails and they give their nephew the mail, and they never change their ID. The bank records all go to their aunt's house because the kid goes to school, doesn't go to school, sometimes whatever hangs around, and he's got nothing to show that he actually lived there. There's no concierge in the building because there is none, so there's no somebody there, third party, who can say, yeah, I see him coming in and out of his house. He has a car parked in the parking lot. Or you don't know the neighbors because in an apartment building nobody knows their neighbors, and so nobody can give you evidence that there are guys living there. Okay, then you have to pay the tax then. So you be careful. So PTT, CRA, they don't look at, well, sure, it's your kid, sure, it's a family member, but they don't just leave it alone at that. Okay, principal residence, if you're actually living there or not, are you actually, so they go further than that. So it's not that you can't, but if you do, you better be careful. Okay, next question.
I think it's same question by Stephen. What clause would you put in the contract to make sure it's good?
Of course, if this is dealing with a market transaction, not a non-market one. Like the earlier question was about seeing family members, so it wouldn't be like a stranger contract. So you wouldn't have necessarily, conditional terms given to your kids or something like that. But anyways, if it's a market one and you're not sure.
I think so. It's about the clearance certificate, the holding.
Oh, okay. Yeah. So to deal with that, so the buyer's lawyer will hold back 25% of the sale price on closing until receipt of the clearance certificate from the buyer's solicitor, upon which the 25% of holdback can therefore then be released within a reasonable period of time. Now, I put that reasonable period of time because sometimes CRA is quick and sometimes they take a long time. Now, technically, it could be a month or 2 months. That's a time thing. And most accountants will tell me that that's the time frame it takes. But I've had one situation where I lasted for 6 months. It's a pretty complicated situation before they come out with a clearance certificate. But fortunately, I made arrangements with I'm acting for that seller who was subject to that holding, to allow me to, just keep on extending the time frame until I actually get it. But technically, you better be careful because the buyer has the right to, if you don't pay that or give me the clearance certificate in a reasonable period of time, I'll just, whatever the holdback, remit it to the GST or to the CRA. If you, Mr. Seller, if you want it, you better go directly to CRA to get the refund back, because the buyer's obligation is up to 25% of the price. You pay it on behalf of the buyer, then you don't have to worry. It's up to the seller to take care of it. But sometimes you get some agreement. Hey, on behalf of that one time with a client of mine, hey, do you mind taking a little longer? Do you mind holding back a little bit further? But otherwise, at some point, buck has to stop and the amount has to be paid to CRA if the seller doesn't do it. Because I've had situations, I'm acting on behalf of the buyer, where there's the holdback there, but the seller doesn't hire an accountant. Doesn't hire an accountant to apply for it, even though there's the money's being held back until we get one. But there's no instructions on behalf of the seller's lawyer that they're going to get one, that they got one. And so then I have no choice after usually about a month and 2 months or so. If I don't get it, then I just say, hey, sorry, you don't give it to me. The money's gonna go to CRA. Okay. So I put a reasonable period of time because that's reasonable. The definitions of it they can find in the courts, but it's not going to be like 6 months or 7 months or a year. Okay. So, anyways, next question.
Next question is, so a Canadian lives overseas cannot buy more than one property and get the exemption on the foreigner buyer tax. Is that correct?
No. Well, no. This different than the let's just say it's a little bit more complicated because one of the things they look at, let's just say, I'm just thinking of a scenario where that may not be the case. That they have to choose one home and they have to call it their principal residence. Okay. Now, the many clients that I've represented, they've got that exemption because that's the house they intend to live in or will live in. Those that are here processing their nomination, and some that are overseas waiting for the restrictions to open, and then they can come back, and then that's where they plan to live. I can very well see the PTT office challenging each of these people that have, especially those that have not yet arrived, and claiming that exemption. They challenge the intention. But then what you have to say is, well, they have this intention, but they can't even come. There's restrictions on travel because even if they wanted to, they couldn't. Will the BC government allow that as an exemption of not showing that they're not intending to live in the home? I'm just waiting for the shoe to drop for that one. I haven't heard of a challenge and an audit based on that. But when the more the benefits come out, the more I see that they're going to look for ways they can attack at the exemptions they've given before. And I could very well see them going after all those people who tried to get exemptions. And hey, you said it's your primary residence, you got an exemption. Well, prove to me that this was your primary residence. And if you don't, you have to pay the tax. So I could see them even after coming to Canada and becoming a permanent resident. I don't put it past the government to do that kind of an audit. Okay, but anyway, so yeah, principal residence is one of the things you are a Canadian, you're non-resident. You're not permanent residents. Oh, sorry. What was the question? Is it Canadian citizen overseas? Is that right? I couldn't quite. What was that question? Because sometimes you have to be sure about whether they are.
Yeah, Canadian lives overseas.
Canadian, then they're not a foreign national. They're the PTT additional foreign tax is more an immigration, and then after immigration, then a permanent residence. If you're a Canadian citizen, and you happen to be a non-resident of Canada for tax purposes, you probably have still have a SIN number from before when you used to pay taxes. and on the PTT form, you can prove that you're a Canadian citizen with a SIN number, then you're exempt from having to pay this tax. Okay.
Okay, so next questions for on new constructions.
Yeah.
If never move in or rent it, the seller can apply the rebate, GST rebate, and buyer will be billed the GST. Is that correct?
Yeah, that's right. That's right.
Okay. Okay, and next question. What if the buyer after completion stays only for a month and then sells it? Does the new buyer have to pay GST all over again?
Likelihood is
This is
yes.
for new construction. Yeah.
The likelihood is yes. 1 month living in it, you can't prove that that was your primary residence. CRA will look at this and says, what? You only live a month? A month is only greater than half of 2 months, just a day under 2 months. What is the word primary? Primary is mostly. So if you live somewhere else for 11 months and you live in there for 1 month, well, that's not your primary residence, and they don't expect that to be proven to be. So therefore, in turn, even 1 month living in it will most likely, from CRA eyes, this is GST applicable. So be careful. So on behalf of the buyer, so don't even get into that, gray line, cutting hairs, and coming from a guy with no hair. Don't want to go there splitting hairs. Okay, GST is included in the purchase price. Done.
Okay.
Cool.
Next question. If we want to write a statement in the deposit section of a purchase contract, should we say the deposit is liquidated or forfeited to the seller in the event the purchase is not completed? Which word do we use?
Well, I would actually use a couple of different ways. And I would add it so that not only is it liquidated damages, here's the thing. If later on, and this is on behalf of a realtor who's thinking of their selling client, not the buyer, of course. So later on, if you can't, say you sell for 500, and then you lose this deal, and the deposit is 50,000, and then later on you try to sell it, and you can't sell it for more than 440,000. So in fact, that you lost 60,000, but $50,000 just a deposit. If you want access to that last $10,000, then you may not want to say liquidated damages, because 50,000 is the deposit. You're saying that's a genuine free estimate of what is owed. You may want to say something like in addition to that, something that would not limit the seller to go after the buyer for any further damages in the event that it's found or determined that the actual loss is greater than the liquidated damage amount. Okay, so something to the effect that allows the seller to continue going after if they suffer more damages as a result. Of course, if the seller cancels the contract, takes the deposit, and they sell it for a higher amount, then they don't, then nothing happens. You've actually benefited. You've got the deposit, you've got the higher amount, so don't need to worry. But you want to cover it just in case you get less, okay? And that's why you put the extra wording on it. Liquidated damages is something that you want to put in is if the losses will be actually less. So if you sell it for 570,000, so the loss is only 30. Yeah, then you want to keep it at liquidated damages because it was 50 is more than what you actually lost, which is 30, but you've already said it's 50 and then you're limited to that. So it's good if you think you're not gonna be able to lose that much, or your loss is gonna be less. So you're gonna say that, hey, you get to keep it regardless. But if it's likely or probable, and who knows that it's gonna be more, then you want to reserve your right to go after the buyer who backs out for more. Okay. So,
okay, next question.
Keep it, and just in case you need more, you reserve your right to go after for more. Okay. Yeah.
Next question. Does the foreign buyers tax exemption apply to buyers that are currently in Canada with a working visa?
Yeah, it does apply, because you can't just be a working visa. You have to apply it for permanent residence. You have to have been given a nominee acceptance, so that you have that document from the PNP program confirming that they've been accepted. And then you got a confirmation number that you can type in right into the PTT form, and then you can be exempt. If you've applied for permanent residence, you haven't received it, then you're still applicable. You still have to pay. You can apply for a refund later, okay? So, you know, you paid for the property, you paid for the tax, then shortly thereafter you become a PR. Within a year from that purchase, then you can apply back to the office to get a refund. But you have to pay first, and then later on you can ask for a refund.
Okay. Next question. If the transfer to ownership is done from a parent to an adult child, how long does CRA has to do an audit on the transaction?
I don't think there's a time limit for the CRA. They're not barred. They're not statute barred from doing an audit anytime, anywhere, any place. You can't say, hey, it's 2 years after that transaction, you can't look at it anymore. CRA, there's no restrictions on the CRA to post-transaction audit no matter what. So, you know, 5 years later, you decide to sell, they look at the transaction, they look at the history, and they say, hey, wait a minute, we think there's a taxable transaction that occurred 5 years ago. They're not barred to going after something that happened years ago. So the question is there a time frame that for a CRA to audit? They can audit anytime. Okay,
so next question. For a foreign entity, one non-resident shareholder has 25 or 30% of the company. The other has 75 or 70, sorry, let me rephrase this. Foreign entity, one non-resident shareholder has 25 or 30% of the company, yes. The other has 75 or 70%. Is this company considered a foreign company?
Yeah, so 25% more of the ownership of the shares is held by a foreign entity. If that company is buying a property, that company is considered a non-resident and therefore applicable to the foreign property tax.
So what's the minimum to consider as a no foreign company?
So 2 points to that one, the under 25% ownership of the shares. And even if they have less, they have no way of controlling who the directors are. So they own it, but they don't control it. They don't have any control over who the directors are. So so you have to go dig in a little bit deeper into the ownership structure and like maybe a shareholder agreement between the shareholders of that company. So a shareholder, like I said earlier, they have an agreement, and this does happen, and even in Canadian companies and not incorporated companies. So I'll just give you an example. In BC, and just so that you can see how the corporate structures, because I do company and business law too. So sometimes I have 3 partners who are running a restaurant, nice and simple one. Okay, each one has 30%, 33, 33, 33. No, I'm not doing this for the show about about the whole idea of 25% ownership. I just want to show that when 3 partners or 3 shareholders come to an agreement that gives one shareholder greater vote when it comes to voting the management of the affairs of the company, that's control. Even though it's not registered, like you look at the shares, they should 1 vote, 1 share. But in the agreement between the shareholders, they can say, well, in the purpose of appointing who the directors are, for that decision, shareholder A, his vote is worth 2. It can actually say that. So then, therefore, even though you look at the books and you look at the corporate books, it looks like it's only 25 or it's 30, but the actual control may be given or greater or less based on something other agreement that's signed between them. Okay, so it's not that simple. So the shareholder agreements or any kind of agreement, that partnership agreement, profit split agreement, things like that, that deals with the fact that if one person is going to get more, control more, then may make that company, even though on the books it looks like it's a Canadian, hey, look, he's only got 20% shares and should be, but maybe not. So if the audit comes in and they look at it and they find out that, look, the profit or the control of the directors is controlled by somebody with a minority share, well, then that's still a foreign company. If that person controlling is a foreigner, okay?
Okay, next question. Would new buyer be protected if the seller has not moved in over 1 year? Is there a time limit? I think you answered that question.
Yeah, so it's, principal residence and primary residence. It's a thing where, in a year, you have to live more than 6 months. But if you just bought it, say for example, in a 2-year period of time, if you live there for a year and a day, okay, most likely. So the most common thing that I would say is if the person has lived in the house for a year after purchase, you're safe. If anywhere up to a year, probably not. So you're not protected as a buyer until they've lived in there at least for a year. Okay, that would be what I would say. And I have situations where the CRA would challenge it based on the fact that, let's just say, the count off the day in which you become a prime residence is 264 days, and the guy moves out on the 264th day. But even the exact day in which they think they should have and they left, they may seriously think of that as an indication of their primary intention all along. Stay there just enough time to get there and then take off, and you still be challenged, right? So CRA will look at that, and then that context, I've dealt with that situation quite often more with residential tenancy disputes when I represent landlords who give notice to the tenant to leave because the landlord wants to live in the home, and then they calculate the number of days, and then they leave just on the day that arrives. The tenant who left sees that there's a new advertisement for a rental unit for that place that they were kicked out of, that the seller was trying to live in. And then they challenge it to the residential tenancy board to get 12 months worth of compensation because the landlord had a different motive to kicking the tenant out. And then the tenancy board goes, hey, Mr. Landlord owner, you left on the exact number of days just when you're not supposed to stay there until that time. So I don't believe that you had a good intention to actually leave and actually live in that property right from the very beginning when you gave that notice to the tenant, and then challenge it for bad faith. The same thing for CRA. So be careful.
Okay, next question. Would 100% of the profit from the assignment of the presale is taxable for a foreign buyer as business income? Does this also apply to a PR or Canadian citizen?
Yeah, it does apply. Yeah, so is a citizen, the amount of the thing about taxing is two things. What is the intention? So if it's short-term duration or a pre-sale, which is normally what it is, if you never intended to live in it, you turn it a short period of time. You remember I gave you those, I think one of the slides had the scenarios. That kinds of questions will be asked of everyone who's trying to say they don't have to pay. Okay, they look at your intention and look at whether it's taxable or not. So you say, hey, I was always going to intend to live in a home when I bought it, but I didn't because some reason come up. Now I'm going to assign it, and I'm going to make some more money out of it. So they'll look at all these things and to make that determination. Whether you're a non-resident, pay a withholding tax. Canadian, you pay capital gains tax. There's still tax unless you show that you really plan to live in this. You can give that evidence. You can challenge it. If they make that assessment. But I'm just saying it's pretty hard to win, okay? Because a lot of the people with intentions, all they have is, well, I plan when my kids graduate and then they're going to live in this house, so I bought for them. But now my kid doesn't want to go to that school and they're too far away. How do you prove that as a real intention? It's hard. It's hard. And you have to prove the contrary intention. You're presumed to have meant to have it as an investment unless you prove otherwise, right? So it's difficult. Intention is like, I'll just give you an example of residency intention. I gave you one already before, where the challenge was based on the 12 months worth of BC Hydro, okay? And then they use that as a way of testing the intention of the person who bought it beforehand. Now, something can apply maybe to an assignment or in any other context. But I just want to give you this kind of as an example of the kind of evidence you might need to prove that in a different kind of a context. So I represented a tenant who was being kicked out of a house by the landlord, who said, oh, we're going to take over this house because my relative is going to come live in it. My client says, this guy has been trying to get rid of me for 2 years. First time he said I didn't pay rent, but I did, but he just didn't know where it was. And second time he said I was making too much noise, but it was because his neighbor was he was yelling at me. I had to scream back at them. Just been trying to get rid of me all along. I don't think that's the real reason that the landlord is trying to get rid of me. Ivan, can you help me? And this was like a day before the hearing. So okay, I can ask questions for you. I can't guarantee. I have no time to prepare. I show up in court, and all I did was ask questions of the landlord. So, Mr. Landlord, which tenant, which of your family members is coming? Oh, it's my son in LA. Oh, your son in LA. Well, this is before COVID, right? So tell me, what do you have to show as proof of his intention to come here? Well, when he comes here, he's going to live in the home. I already told him that. Well, do you have more than that? Well, then he said, no. Well, then I started asking these questions, such as, well, is he a American citizen? Yeah. What, does he have a visa application to come to Canada? No. Well, what does he do in LA? Oh, he runs his own business. Oh, well, has he sold his business? No. Has he tried to sell his business? No. Does he own a place? Yes. Does he try to sell it? No. Your Honor, there's no evidence of intention to come here to Canada. He hasn't even got his visa, hasn't quit his job or sold his job, hasn't even sold his place, hasn't even tried. Your Honor, this is the bad faith that the landlord's intention to kick my client out is invalid. Boom, cost. So you look at these things as evidence and proof of intention, right? In immigration context, I've had, because I used to do a lot more immigration, I don't do as much now, but I have an example of a client who had sponsored he married his wife from Taiwan. He's a Hong Kong resident, but Canadian citizen. He plans to bring his wife and kids to Canada once they settle. The question was, well, geez, you've been living in Hong Kong for the last 5 years. What evidence do you have that you're intending to live here in Canada? The guy has a company in Hong Kong, and he has his wife living in Hong Kong with their 2 kids going to school there. So before we make that application, we start gathering proof of intention to come here to Canada to live. They've already scoped out a school. They've already got the kids' applications for the student visas. They've already got a place that they're going to buy. They got to hire their agent here. They've already started looking. They've got a few offers that got rejected. I got the agent's information about the agreement for them to represent them. I've got the new company that I helped him incorporate because he's planning to do a new business here in Canada. I've got the letter from his other company, which means that they're already looking for a new director to take over his position. Boom. Intention of future intention, evidence of future intention to reside in Canada. So this is the kinds of stuff, no matter what situation, when it comes to primary residency, which is applicable for CRA, PTT, landlord tenancy, all this stuff, okay? Sorry, that was kind of a long-winded answer. But anyways, hope you get my drift and my points.
Same question, another question in the same topic. Is not capital gain for PR or citizen, which 50% of the profit is taxable instead of the 100%?
That's true. Yeah, if it's a capital gains, yeah, it's 50%. But how do you determine whether it's a capital gain or is it income? So you have to prove intention. So a permanent residence, you're usually, hey, was it your intention to make a profit? So therefore, if it's a profit motivation, then it's income. If you happen to have something and it happened to gain, and then it's capital gain. So it's a matter of intention and proving it. So how CRA looks at something as income, especially when it comes to foreign residents, they look at how can you say that you're going to have a long term? It's got to be income. But it may be different for a Canadian who, may be different because they're Canadian, they live here. They can have 10 or 15 different properties, one of which is, gain, one of which is profit or intention. But, so anyways.
Okay, and then last question.
Mhm.
Is GST applicable to the sale of one bed plus study, condo reno involving removal of a kitchen wall, new cabinets, and new hardwood floor throughout?
Yeah, so the definition when it comes to GST is applicable to an existing home. One way of looking at it to make that earlier determination is whether or not someone can live in the home while the renovations are being done. If you can start from the bed while you sleep in the living room, okay, probably not. If you've got to remove the windows and it's got to be windowless for a couple of days, it's getting on between the gray area. Hey, can you live in a house with no windows, an apartment with no windows? But then look at this point. If you need a brand new occupancy permit because it's been so substantially renovated that it was not safe to actually live in the home while the renovations are being done. So that's a good test, right? It's not that you can bear and tolerate the wind or the noise. It's whether it's safe or not. Okay. So, so whatever you renovate, if it's, safely, you can live in there, you can just tolerate the noise a bit, then again, probably not applicable. But if you had to leave and it's not safe to live in the home, you can't live in the home, then it's quite likely that GST becomes applicable again.
Okay, so there's no more question.
Yeah.
I guess we'll go with your price draw.
Yeah. So, anyways, I was trying to figure out some questions, but I know all of you. There's 2 prizes today. There's Amazon gift cards. The winner is the first person who puts the answer to the question on the chat. Hold on. Let me try to see if I can open the chat. I can't seem to open my chat box. I don't know why.
It's the like on the bottom of the screen, you can see there's a chat box.
Oh, there it is. Okay, good. I have to open it up. Okay, there we go. We are gonna answer some questions. Some are personal. One question is a personal thing. Not to someone who's part of the Jovi family and someone who is actually present right now. So, John, do you want to ask this question? So let me see. We discussed this a little bit. Okay. Okay. The question is, now all of you may have known that John had done this exercise regime where to test and prove that he can accomplish some physical, like I thought it was a Herculean thing. So he does a lot of push-ups for a lot of number of days. To answer this one, how many push-ups did John have to do, and for how many days did he do it for to get the first prize? So 2 parts to this one. You have to get both. Okay. How much per day, and how many days? We're not going to do the total. I want how many per day, and then how many days did he do it for? So you might have to do some division if you add it up and you divide it up. So, oh, there we go. Jay. I think Jay Ng was the first one. Okay, the rest of you can, I guess. Hold on. Nope. Yep, there we go. Jay. Jay is the winner. Okay. Right.
So it's like 300 for 34 days.
Or is it? Yeah, 300 a day for 34 days.
Okay.
So congratulations, Jay. So one of the things you can do is I'm gonna switch over to my here. There, where's my, okay, there. Sorry, get the screen. Am I still sharing the screen? Yeah. Okay. So you can see my text here. You can WhatsApp me. I'm on WhatsApp. Use your cell phone. Text me your card, Jay, and of course, and then you have your email, and therefore, then I can send you your Amazon gift card. Okay. Awesome. Congratulations, Jay. Now I was gonna ask John about how many calories did he lose and how much reduction of his girth or expansion of his muscles, whatever. I won't ask that. Number more calculable, 300 or 34. Now, now, maybe you can reply that. Now, at the very outset, I said it was going to be my anniversary in the next on the 21st of May. How many years would I have been practicing by May 21st? So, first person who was listening when I talked about how many years I've been practicing at my anniversary, first one who puts in the number of years is the winner of the next prize. Okay. Okay, this is it. Whoa, look, close, getting close. Oh, okay, I'm going down, down. Oh, there you go. It's Mr. Sandu, Bal Sandu. Okay, 24. So May 21st, 24. Thank you, congratulations. So do the same thing. This is my cell phone. Put me on your WhatsApp. Send me your card. And then I got your email, and it's an email sent through Amazon. So when I get the gift card on Amazon, then I send it through Amazon. You get an Amazon letter, and when you receive it, it'll notify me that you received it. Okay, sounds good, guys? So J, Ing, and Sandu. Okay, well, anyway, thank you for everyone for coming and attending, and hopefully, if you want some other topics and presentation stuff, make sure you let John or Calvin or anyone at the Jovi office there to know, or Brenda, if you think if there's something that you want me to talk to your agents about, I'll be happy to schedule another time. Okay.
Okay, thanks, Ivan.
No, you're welcome, guys, and you guys all take care, stay safe, and I look forward to seeing you guys again in different, more open situation. Okay. And one of these days, maybe we can all do John's 334-day thing. See if we can do it. I need to lose my at least 30 inches off my waist. That's for sure. Okay, take care, guys. Bye-bye, everybody. Okay. Oh, one more thing. If you guys want the PDF with hyperlinks to the the regions and the case law, just email John. Or email me if you want, and then I'll send it off to you guys. Okay. Take care. Okay. Bye-bye now.